Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. I have with us today a special guest. His name is Brian Adams. He's the president and founder of Accessory Capital, where he spearheads the investor relations and capital markets arms of the firm. He has 10 years of experience in real estate, private equity, and advanced knowledge in best practices for strategic real estate investing. Prior to forming Accessory Capital, Brian co-founded Priam Properties, an institutional real estate private equity sponsor in 2010, and provided leadership and direction for the firm in connection with capital markets, investment management, and investor relations. Brian, welcome to the show.
Thanks for having me.
Yeah, thanks for joining us. I always love talking about real estate. It's one of the main focuses of this podcast. You know, real estate alongside infinite banking or bank on yourself, like how we talked about on your podcast, and talking about different ways of growing wealth through real estate. Before we jump into all that stuff, can you tell us a little bit more about your background?
Yeah, happy to. Thanks again for having me. So, as background, I am originally from New York. I married a Nashville native. We met up in college in Connecticut. We went to grad school in Boston. So that's where I went to law school. I moved to Nashville about 15 years ago, and my wife's family has a single family office that has invested in commercial real estate and venture and private equity for the last 20, 30 years. So while I was practicing law in town, I got exposure to some of the investments we were making with various GPs and sponsors, et cetera, became enamored with real estate as an investment class and also just as a business. Connected with my business partner, and we started the firm 11 years ago. And we'll probably get into some of the details, but we initially were raising funds and doing some other things that really pivoted to just doing deal by deal syndication. And today we have about 2.7 million square feet under management, which is about a $400 million portfolio across 14 markets, mostly in the Southeast and the Midwest.
Nice, definitely. And are you still practicing as a lawyer?
No, Lord, no. I retired my license a number of years ago. I do not give legal advice any longer, but yeah, no more.
Do you think your training as a lawyer, like you're going to law school and prior and you were a lawyer, do you think that has helped you in what you're doing right now with the family office and real estate syndications?
I think it gave me a lot of credibility when I was younger, frankly.
Yep.
And it taught me how to think critically through problems. So I think from a mindset standpoint, it certainly did. I never practiced long enough to really get sharp skills. But it definitely helps when we're dealing with a transactional issue or a leasing issue. I know the questions that need to be asked, and I've seen the fact patterns to know what's important and what's not important. So from that perspective, yes, but I'm also happy to pay people to do the daily legal grind on our business.
Absolutely, yeah. And you mentioned single family office. So for those who don't know, what does that mean exactly?
It's a great question. Nobody's got a really good answer for it. And on my podcast, I always ask people who live in this world, give me your definition of a family office. So my definition of a family office is a corpus of assets, like a pool of money that is controlled and held by one family, that you create a small business around that pool of assets or that corpus of assets that is meant to maintain a quality of life over a multiple generational time horizon and avoid paying taxes. Now that's a single family office.
Yes.
That's just one family that's meant for the benefit of certain lineal descendants of a patriarch or a matriarch.
Yeah.
A multifamily office is when a number of single family offices club up together or all get organized under one holding company type structure for shared economies of scale and efficiencies and for the benefit of those families. And those are becoming very popular as the cost of running a single family office rises dramatically. Multifamily offices, typically through an RIA structure, have become really popular. So that's the differential.
Okay. And it's a pool of capital that's being shared, but also a pool of resources, right? Like you have your legal team, your accounting team, private equity, and different divisions that can kind of look at different angles of potential opportunities and problems.
Yeah, I mean, there's an adage in the family office space that if you meet one family office, you've met one family office. So just as other families who maybe don't have as much assets under management
Mhm.
are schizophrenic and crazy and hard to deal with, family offices are no different. So there's really no consistency from one to the other. Our family actually recently moved most of our assets to a multifamily office platform.
Mhm.
We don't have a lot of in-house professionals,
Mhm.
but some of these families have, to your point, a COO, a CIO, a CTO, multiple kind of professional level, management level folks.
Mhm.
Others don't have any of that. So it really just depends
Mhm.
on the family.
Got it. That makes sense. It's not like they're all the same. It depends. Now let's talk a little bit more about what you're doing on a day-to-day basis. So you're doing like syndicated deals, like partner deals right now. Is that right?
Yeah. So we're trying to solve three things in our
Uh-huh.
marketplace: access to direct deals, double digit cash on cash yield, and then all the tax benefits that come from direct real estate ownership. So those are three things that we do because that is a solution set that we know solves a problem within our investor base of taxable but non-institutional investors. So high net worth individuals and families and the wealth management firms that represent their interests.
Uh-huh.
What that looks like right now is flex or industrial or medical office buildings in secondary or tertiary markets, mostly in the Midwest and the Southeast. And these are usually $10 million type acquisitions,
Uh-huh.
cost basis.
Okay. Now the three things you're solving, so access to deals, double digit cash returns, and then direct real estate ownership. Could you mind talking about each one of those and like an example of those problems that you're solving?
Sure. So there's really two ways to do real estate investing
Uh-huh.
today on the private side. You go through a fund or you do a syndication.
Uh-huh.
And the easiest way to explain this is a fund is an investment where you have capital, but you don't necessarily have deals.
Yeah.
And a syndication is where you have a deal, but you don't have capital. And there are pros and cons and benefits and disadvantages to both. We've raised three funds in the past. We really think syndications are what makes the most sense for us as a firm and our investor base. And so when I say direct deals, that means that people are coming in on just one particular property, right? So if I identify a property in Dallas, Texas, it's
Yes.
an industrial deal, and you come and invest alongside of us as a partner in that investment, you are only investing in that one single asset property in Dallas. There's no exposure to other deals or investments, et cetera. So you might be missing out on some diversification, but you can really underwrite to exactly what that risk profile is on that one particular deal. And what we found was in the ultra high net worth individual and family space, they had access to deals through their financial advisor or through the marketplace. But deals are suboptimal, in my opinion, for these investors because you're calling capital down over the series of 3 to 4 years. You're deploying that capital over 5, 6, 7 years.
Mhm.
You don't know exactly what the sponsor general partner is going to invest in. And the mechanics and the inefficiencies of the fund, I think, don't make up for the diversification they can provide to you.
Mhm.
And so the feedback we got from a lot of our investors was, I want access to direct investment opportunities. And so that's how we structured our platform and our syndication work. On the yield side of it, obviously we've been in a low interest rate environment
Yeah.
for forever. And bonds and fixed income have really been pretty subdued and muted
Mhm.
for the last 20 years, right? I mean, I don't know what the 10 year is today, but it's probably something like below 2%.
Mhm.
And when you're a taxable investor
Yes.
and you've got liquidity needs and um, you're looking to find yield somewhere, fixed income, bonds, private credit, all of the traditional places that you used to go, because of this huge amount of liquidity in the marketplace, yields are really, really, really low and
Mhm.
unattractive, in my opinion, for most investors. So we created a product offering that gave people what we thought justified the risk and the illiquidity of our investments, which is a double-digit plus cash on cash yield annualized,
Uh-huh.
but we make monthly distributions.
Two questions. So first question is what exactly like taxable investor? Does that just mean an investor who has tax liability that they have to pay every year or
Right. Sorry. No. Well, I mean, yes, but when I say taxable, there are two different investor pools in the world.
uh-huh.
There are non-taxable institutional investors, so pension plans, endowments, um, certain other insurance company buckets of capital. Those are non-taxable, right? Um, those are 501c3 organizations or certain organizations that are tax exempt.
Okay.
Whereas individuals and families, we're all taxed, right, on our
Yes.
income. And so I think as a general partner sponsor, it's really important to focus on one of those groups. I think it's hard to work with both because obviously there are certain things that you can do or can't do that will be impacted from a tax perspective. And for us, when we talk to our investors, we really want to make sure that we're providing them with a value proposition that is net of fees after taxes,
Okay.
because that's how investors should look at investing their capital. Who cares what the gross numbers are?
Yeah.
Because it doesn't matter. At the end of the day, it's net of fees after taxes. What's the real return going to look like? And so when I say taxable investors, that's what I mean. We don't work with institutional LPs like a endowment or a pension plan.
Okay, got it. That makes a lot of sense. And then double digit cash return. Do you mind sharing what an example of what that means? Like from a like just explaining some numbers?
Sure. So if we were we're looking at buying a property right now in Savannah, Georgia.
Uh-huh.
It'll be a 11% cash on cash yield, which means that if you were to invest $100
Uh-huh.
into the investment, you would get $11 back annually. And it would be in monthly distributions. So it'd be like less than $1 a month.
Okay. For as long as you're with that investment, right?
So
So
the
if it's
whole
like
period.
the whole period. Okay.
Yeah.
Okay, that
Correct.
makes sense. Okay, perfect. And then do you like your specialty you said flex, industrial, medical. Um, so that would be more on the commercial space. Do you do anything on the residential side?
No.
Okay.
Yeah. It's just hard, right? I
Yeah.
mean, there's just so much competition on the multifamily space and where cap rates are. Um, I don't like to compete in places where um, other folks are super well capitalized and really, really smart.
Yeah.
And on multifamily, there's some great GPs and sponsors who are super well capitalized that are really smart. And I think it's just hard to create value there right now.
Definitely. Has the recent, like I would say probably maybe the last year, a jump in real estate values, has that impacted what you're doing on a day-to-day basis?
Yeah, for sure. We've had to go down market in terms of deal size.
Uh-huh.
Whereas we used to focus on 15 or $20 million acquisitions. And now it's probably more like 10 million acquisitions. And then we've had to go to different markets, right? I think it's some markets have just become too competitive. Like a place like Nashville, it's a great place to live.
Yeah.
Very challenging place to invest money right now. It just there's a lot of competition.
Mhm.
So those are probably the two biggest factors that we've incorporated into our deal flow right now.
And how do you find your deals?
So we have a team of acquisition folks who are on the phone all
Uh-huh.
day talking to brokers. Even though some of our market um, investments might be off market, they're still typically intermediated by a broker, right? So a broker is still typically representing the seller on the
Uh-huh.
transaction. What we found is on these smaller deals, leasing brokers typically have the best relationship with the ownership selling group. And when you start doing $10 million or under acquisitions,
Uh-huh.
the buyer pool is very shallow. So there's just not a lot of very good actor, professionalized buyers for these
Mhm.
type of products. So for us, the pitch is typically, hey, we're not going to be the most competitive on price, but we will not retrade you. We will act as gentlemen. We will transact in a very fair, professional manner. And because we third party lease and manage our assets, if you give us a 30-day first look or a window on the deal before it goes live on a marketplace, we will keep you on the leasing work. And that's really driven a lot of off market opportunities for us.
So it sounds like there's a lot of negotiation involved. And how did you like what are some things you do to like practice negotiating? Is it just all for experience from doing this, or like do you have other ways of practicing that?
The way I practice it is that I have a business partner who's Indian that that loves to negotiate, and I let him do all the deals because
Awesome.
I'm not very good at it, but he loves it. He thinks it's like the most fun thing in the world to do, and
Yeah.
it just like I think for him it's like going to the market and like negotiating over a rug or a piece of jewelry or a piece of fruit. He just naturally does it. He loves it,
Yeah.
and he's good at it. So I'd let him do it. I just want everyone to be happy. So I'm great on the investor relations marketing side, but on the deal side, you probably don't want me negotiating your deal. Frankly, it's not my cup of tea. But he
Mhm.
loves it. He's good at it. So yeah,
Yeah, definitely. I think it's obviously a big part of business, being able to negotiate with people and kind of conveying like messages and influencing people to take a certain direction. And like how it's not always about price, it's not always about money. It could be other factors, and this is where like it comes in, and having good negotiation skills come in. I want to go back to taxes real quick. So, what are some of the tax advantages of investing in deals like through
yeah,
syndications, for example, like from the investor standpoint?
yeah. So when you hear people say don't fight the Fed in terms of how they're investing, I think that makes a ton of sense.
Uh-huh.
I would say don't fight the IRS.
Uh-huh.
And if you look at the tax code as a set of incentives and disincentives to encourage or discourage certain investment behavior,
Yeah.
the whole thing is set up for you to own your own home, get married, have children, and invest in commercial real estate.
Yeah.
Like that's the incentives that are laid out, right?
Yeah.
So through cost segregation analysis and
Yeah.
accelerated depreciation and bonus depreciation under the Trump Tax Act, you can show losses on your K1
Yeah.
early on in your ownership of your investment with us while still getting a double digit yield. So not only are you still getting that coupon, but you're getting that loss in your K1 that you can offset gains elsewhere in your portfolio. So just an incredibly powerful tool if done correctly for taxable investors. And it was a big focus of ours when we started the firm. And so we have an in-house controller who's a CPA with a public accounting tax background,
Uh-huh.
just to make sure that everything is taken care of and done correctly. So it's a big value add for us.
Yeah, definitely. I had on episode 5 of the show, I had Yona Weiss on, and he talked about cost segregation and the
Yeah,
tax benefits behind that, which is
it's
pretty cool.
so powerful. Yeah, it's
Yeah.
incredible.
Mhm. Yeah, definitely. What are some typical like per investor, like the sizes of their actual investments, like minimum, maximum that you've seen so far per investor?
Yeah, we have a lot of flexibility there. I'd say that our average investor is probably in that $100,000 range. Um, but we have some groups that have higher minimums. And luckily, the advances in technology from a reporting and communication investor relations standpoint have really allowed us to have lower minimums and be able to service more and more clients and investors without having to sacrifice the experience. But that's typical for us. I'd say that $100,000 range.
Okay, that makes sense. And do they have to be accredited investors?
Yeah, for us they do. Yeah, we
Okay.
don't work with unaccredited.
Okay, it's I forgot what the regulations 506
506C.
C, and then
Yeah.
B is the one where you don't have to be an accredited, right? But you have to
Correct.
know the person. You have to have a relationship with them before.
Correct. I don't know all the unaccredited rules because we don't play in that space. But
Yeah.
for us, you have to be accredited. It's self-certifying. We have to have a good faith belief. And then you have to have a 30-day cooling off window between the first time I talk to you and then when you ultimately invest in one of our opportunities.
Gotcha. Okay. And then I'm sure you have like a securities lawyer, right? Like, do you have one that's ongoing, like that you are constantly working with, or is it like when you just set up all the stuff initially?
No, we don't bother with any of that stuff.
Okay. Okay.
Yeah, no, yeah, we do. we have outside counsel that does all of our securities work. Yeah, it's obviously important. So,
Okay.
yeah, somebody that we've been working with for a long time
Okay.
that does a good job. So
Okay, that makes sense. Yeah. Well, Brian, I appreciate you being on the show. How can listeners connect with you and learn more about what you guys are doing?
yeah, thanks for having me on. I'm super active on LinkedIn. So if you want to just look up Brian C. Adams, Excelsior Capital, connect with me, shoot me a note. I'd love to chat with you. And then go to the website, just Google Excelsior Capital, Nashville. And it's got a bunch of great resources on there, white papers, webinars, blogs. And that's probably the best way to learn more about the portfolio and how to learn more about being an investor is through the website.
Okay. I'll be sure to add in all the links in the show notes. That way listeners could just click and connect with you.
Awesome.
Yeah. Thanks for joining us. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.